Welcome back. It's part 2 of debunking the investment myths with me, Jason Labrum, your host, and my man, Alex Klingensmith. I did it for you that time, Alex.
Thank you.
It's always going to be a mystery. Do I say with Alex Klingensmith or do I say with and then you say Alex? I don't know. What should we do?
It's good for us both to practice.
It's exciting.
It is exciting. So if you're tuning back in, thank you. We are super excited about sharing the debunking investment myths presentation with you here. We went through part 1. We talked about sell in May and go away. We talked about market timing is the key to high returns, not. We talked about now being the wrong time to invest and even holding cash is better than investing. And we debunked all those myths, didn't we, Alex? I mean, we crushed them.
I think so.
With
You guys
data.
are myth busters.
Myth busters, like Ghostbusters, but we're myth busters, the financial myth busters. That's cheesy.
There was a show. There was a show called
Mythbusters.
Yeah.
No, there was? I don't know this. Should I know that?
With Adam Savage and Jamie Heineman. Yeah, it was good.
I'm with you,
good.
Brian. Jason doesn't. He only knows music.
Am
Apparently.
I too old for that?
No.
It's Discovery Channel stuff.
Yeah, back in the day. You're financial mythbusters.
It's
Okay.
a cool show.
Well, here we go. Part 2. We are going to be talking about stocks and the fact that they have risk and maybe they're too risky. We're going to be debunking myths on that. Investing is only for rich people, of course, and it's like gambling, and even fallen stocks will always come back. So that's where we're going here in part 2. Thanks for tuning in to Financial Detox. We love you to check us out. Give us a subscribe and a like and your comments. If you're interested in chatting with us or getting thoughts about your own investment strategy, then please feel free to reach out. We love helping people make better investment decisions and getting financially detoxed. There you go. So let's jump into it. Stocks are too risky. Have you ever heard that, Alex?
Yes, I have heard
I
that.
mean, all the time, right? You hear it all the time. You hear it from really smart people, man. Stocks are too risky. It's the next one is great too, gambling. But are stocks too risky? Let's think about this and debunk this myth. I know they are volatile, but I guess the question is there a difference between volatility and risk? Risk to me is when you own something or you have something that can go away, literally be gone. You could risk it, right? You think about climbing Mount Whitney, which I had the privilege of doing, not hiking it, but actually climbing the east face of Mount Whitney. There was real risk involved, right? A rock could break, your equipment could fail, and there was risk. Owning a single stock that is a new AI technology, just one stock, there's real risk there. It could go away and not come back. However, if you own a diversified portfolio, like a big basket of 1,000 of the biggest and best stocks in the world, is there a chance that all 1,000 of those companies are going to go away in any single instance, week, month, year? Not historically, that hasn't happened. So volatility is often misunderstood as excessive risk. And over time, the volatility actually is what creates returns. Because it's volatile, there's a reward for handling that volatility. That's what capital demands. So capital, we as humans investing our money, we demand a certain rate of return if you're going to use my money. And when I buy a stock, I'm giving my money to that company as capital that then they can go use to grow their business. And as an investor and a human with capital, I'm going to demand something back in return for you using my money. Just like with a bond, I'm going to lend you my money. I don't own equity in your company, but I'm going to lend you my money. You're going to pay a specific percentage of interest, and at maturity, I get my money back, but I expect that interest, right? I expect that certain rate of return.
Mm-hmm.
Go
It's
ahead,
funny.
Alex.
I'm listening to you talk. I'm just looking at the picture.
And you're
I'm
falling asleep.
No. I think we're going to talk to two different audiences at the same time here. So if you look at the picture, I'm a picture guy. I'm a visual learner, right? I'm not out of story. That's why when we went on our retreat to El Salvador, I read books. I like pictures.
Yes.
Whereas you listen to the same book and I read the same book, and we both kind of come together to the same conclusions. But
you also nap very well. You're a very good napper.
Thank you.
In the hot sun, where I can't imagine anybody could nap when it's 90 degrees with 90% humidity. But you,
no problem. But look at
That's because you're Chilean, dude.
I don't know what it is. I guess there's a lot going on usually in my life. So if I have a moment of silence where it's quiet, like I'll just take a minute and just, close my eyes. So look at the picture. You got a picture here with a bunch of squiggly lines. You got the dark purple, the pink, the brownish, the kind of blue, and then the flat green. So what you just said, really eloquently put, as a professor would educate a classroom, I'd say, well, look at like, which line do you want to be on? And I think everybody initially be like, well, I really want to be the dark purple because that's my $1 went to $2,740. Is that what that says?
Yep. Give or take. We'll call it that.
And then some people who actually look at this closer are like, wait a minute, like look at the ups and downs around 2020, even in 2024, 25, there's some pretty roller coastery rides. That's the volatility, right?
Yep.
And then you go to the green line, you're like, well, geez, I only have $128 compared to your $2,700, but my line barely moved. Yeah. That's what we're talking about here, right?
We are. And I think when you look at the verbiage to the right, we can recognize, and you must recognize, that bonds are about half or more less volatile than stocks. Stocks are twice as volatile as owning bonds. But yet the rate of return is significantly more for stocks. Why is that? We talked about capital, and it's that same scenario, is that we as investors have capital, money, and we demand a certain rate of return. And if you tell me that there's more volatility, I'm going to demand a higher rate of return. So I think it has generally always been that stocks will produce over longer periods of time higher returns than bonds. And I think that will continue to be the case because they experience more volatility and investors demand that higher return.
I would add to this slide, though, just because we are us and we can't help but share that we believe in diversification amongst stocks, for example. So we're not saying to go buy one stock and be like, hey, they said it was going to be volatile. That's normal. And even the slide shows S&P 500, and at least you got another index on this one, Russell 2000, which is a different
small
index,
cap stocks, right, versus large cap.
So there's 2,500 companies. There's some diversification, but I mean, there's way more stocks than just that. And so it's important to not only own stocks, understand there's volatility, but know that not all stocks were treated equal, right? Some stocks are more volatile than others based on what type of companies they are. Large, medium, small.
Excellent point, right?
So, and we believe in having a little bit of everything with an intentional allocation to each thing, which rebalancing methodology and all of that, right?
Yeah, I think the best, and maybe it's because I love being on a boat or wake surfing or wakeboarding, but as you drive a boat, if you hammer down the throttle, full throttle, and you're going across the lake and there's any bumps, it's going to be really rough and bumpy. If you pull that throttle back, it's going to be a lot smoother and you're going to glide over the waves. So as an investor, you get to, with a good advisor, hopefully, will help you design and customize a portfolio that has the right mix and match of different equity types, as Alex just talked about, and fixed income types. And hopefully they're bringing in private investments and alternatives to even further diversify away volatility and provide potentially higher returns. That mix and match should be customized to you and to your cash flow based financial plan. And you have a beautiful scenario. So stocks aren't too risky, and you really need to understand the word risk versus volatility, because if you have a well-diversified portfolio of stocks, there's been no time in history where they've all just gone away and never come back. And I would argue that if you think all stocks on the face of the earth, Apple and JP Morgan and J&J and Bristol Myers and Charles Schwab, every stock in the world could just disappear at one single time, the problems are going to be so much more significant than your portfolio being down that that's like a guns and ammo, get a horse and a buggy and figure it out kind of scenario. So that's not realistic, and we shouldn't live in that world. Let's go to the next one, Alex. This is one that comes up. Investing's only for rich people, right? You can only invest if you're rich. But yet we have the eighth wonder of the world here that can help you, if you're not rich, become rich. So investing is for rich to stay rich, wealthy to stay wealthy, but it's also for people to create wealth, and the mindset has to shift. If you have a mindset of I can't invest because I don't have enough money, you will never have enough money. But if you have a mindset of I'm going to start investing so that someday I'm wealthy or rich, then you will end up having that happen. So the power of compounding, eighth wonder of the world, small regular investments over time, big money, right? So here you're looking at three different colors. You've got the purple, you've got the yellow or orangish, and you have the blue. And we're talking about the contributions. And if you are invested in a diversified portfolio of stocks and bonds, purple, or just stocks. And by $50 a month over the last 25 years, you would have contributed a total of $15,000. And your $15,000 would be worth $76,000, right? The power of compound investing. That's $50 a month. That's way less than the Starbucks effect or the latte effect.
Yeah, I actually met a few. We're interviewing right now many times as we're looking to hire for different roles, and I get to interview a lot of people of the generation that's just now graduating from college.
Yeah,
and it's blown me away at some of the awesome preparedness that some of these young folks are having. That they were taught these principles early on, kind of like we did a show a little while ago about the foundational aspects of parenting and how that like age group between 16, 17, 18 years before they're going off to college and as adults. There's a lot of delayed gratification that comes into play. I've been really impressed when I ask them some questions in the interview process about how do you invest right now? What are your beliefs around investing? What have your experiences been so far? Some of the stories that have been shared with me by, these are like 21, 22, 23-year-olds. It's exactly this concept that they didn't have much. They're kids. They're young. They're going to school. But they've been taught how to save, not only save, but save in the right kinds of ways, like through Roth accounts, for example, Jason.
Yeah.
Where there's these young folks. I'm like, man, I wish I had that kind of discipline when I was your age. It's really admirable, actually.
I do think that the general knowledge around investing and the perception of how to do it, that young people can oftentimes be much smarter than older people because they seem to understand this better. Where there is a generation, I'll call it the baby boomer generation, that feels like, I'm an engineer. I'm a smart guy. I can time it. I can figure it out. I should be able to buy this stock and pick this hot stock and stuff. There is definitely a gap there where I think the younger generations have an advantage because they aren't stock pickers. They didn't grow up in the invention of Charles Schwab and being able to first trade a stock and, I'm going to buy some Exxon and buy some J&J or whatever. So it's a different deal. But the bottom line is here, it's not for the rich. It's how you get rich. It's how you create wealth. Use your 401k, get your company match, put in $50, $100, $200 a month and watch it turn into 5 or 10 times the amount of money if it's well diversified and invested and you follow these other principles of investing and debunk myths. Here we are in part 2. Let's keep going. Part 2 of debunking investment myths. Investing is just like gambling. Let's take a look at it.
This is your slide, man. I've seen you finally have a slide to support all the stuff you've been saying about gambling.
Thank you to our partners over at White Charts. They give us some really great data. Mustafa at White Charts, you the man. Shout out to Mustafa. Gambling is totally chance. And you can almost get to 50%. Well, 50 at craps, right? Blackjack's my game. I love blackjack, 49% chance of making money. But what if I told you that investing in the public markets or diversified equity portfolios, even on a 1-year positive returns over, we got 5, 10, 15, and 20 here showing, but the positive returns over even a 1-year period are 70%. The positive returns as you get into bigger periods are even more significant. If you look at 5 years on the bottom there, positive returns happened 81.4% of the time. You had positive returns in just the S&P 500. You got to go back to part 1 and listen to Alex talk about the S&P 500 is not a great investment portfolio. It's only US stocks. It's only large cap. It's predominantly growth. A much better portfolio would include all facets of the economy in the globe, even US and international. So this is not even giving you the best benefit of the doubt. But if you get to 10-year periods, we're up to a 92% chance of making money. If I told you could go to Vegas and play a game and have a 92% chance of making money, I'm living in Vegas. I'm going. But you can. It's right here. And it's not Vegas.
I'm not an engineer or a lawyer, but I actually hate this slide the more that I look at it because it's not even the right framing of the conversation. When you're in Vegas, Jason, you're going one hand at a time, right? Or one sitting at a time, one session at a time.
True.
When you're an investor, is that how you're investing? Is like one day at a time, 1 month at a time, one session at a time? Like, what is that even?
Not once you've gone through financial detox, busting investment myths. No.
Tagline.
Yeah. But when you just invest willy-nilly, or you think you can figure it out or game the system, it doesn't work well. But
I want to redo this slide. There's so much opportunity to like frame this better, where it doesn't, like, I think at the attorney's like, this isn't even the right information. Like, what are you talking?
Man. Well, then we're leaving it. Let's go to the next one.
No, hold on. What if I want to run with this. I want to make a better slide. What if we're saying, okay, I'm going to play 6 tables of craps at once, 10 tables of blackjack at once. So there's my international, there's my emerging markets, there's my US, and I'm going to do it for a year.
Yeah. Well, you're going to be at 49% and 50% if you play perfectly.
Yeah.
And if you do it for 5 years, it's because it's chance. You're going to still be at the same numbers. And if you had just left your money in the portfolio, you would have 30% chance higher of making money. You'd be up in the 80% probabilities of success, or 90s. So
I should still stay out of the casino then, huh?
Yeah, stay out of the casino unless you're having fun. Look, I think if you're
I hate it. I don't even like casinos.
I hate losing money, but I like the free drinks and the air condishing and the oxygen they're pumping into your system.
No, it
That's
smells
fun.
Gross now.
It is gross.
You can
the
have
shows are good. How about the shows? Zach Brown at the Sphere is going to be insane.
That's a good point. But there's no casino involved then, right?
Yeah. Who needs to gamble when you got Zach Brown at the Sphere? Okay, let's keep going. We got to rock. Fallen stocks always bounce back. I love this. In fact, I just had a client who finally just capitulated. They're like, man, I'm just done. Take it, sell it. I'm done. I mean, this stock is...
Oh, man, I owed AIG. I remember that. That was terrible. My first bad experience with investing.
Stocks that go down don't always come back. And here's some examples, right? So just because the stock is lower today than it was, or has had a horrible beat down, does not mean it's going to come back. And that's, again, why hanging on to one single stock or 2 or 3 single stocks is really tough. Let's not spend too much time
on this. I'm reliving a really
you hate the last one. I think this one's boring.
But let me make it more exciting for you, because it involves me in a lot of pain.
Like, oh dear, here
emotional pain. No, I remember like
this
thinking
is
I was
turn into
like
counseling for Alex. Y'all.
No, it's okay. I've accepted my loss and moved on. But in like 03, 04, see this squiggly line on AIG. I work for a company that was an AIG direct kind of supplier for insurance sales. And so I believed in AIG. It was huge at the time. AIG was like one of these big giant companies. And I invested what at the time I thought was a lot of money for me, at least, right? I was 23 years old or something. And guess what? It's even worse than that chart shows you, because when that stock went to close to zero and the US had to bail out AIG, too big to fail was one of these companies.
Yeah.
They actually didn't they converted the stock to something that I still don't understand. My money never came back. Yeah. It didn't go 95. It went to zero.
You got wiped out.
Wiped out completely. And then they reset it through warrants or something. And I'm like, what happened to my thousands of dollars? Like, you're done. Sorry. Start over.
Tough deal. Holding on to a single stock and thinking, there's a difference between a good company sometimes, not always, but a good company and a good investment. The client story I opened up with, they really believe that this company is a great company, the one to remain nameless at this point. It's a great company. I know the owner. I know what they're doing. They're big business. They're a great company. It's a publicly traded company, so he knows the CEO, but it's not performing well. I'm like, just because it's a good company or you like what they do doesn't make it a great investment. And why are we sitting here trying to pick one hot dot? It's tough, right? Why don't we just own a bunch of stocks? The market's gone up a bunch. You'll do well. So it's a tricky one. I got a story too. I've told it before on Financial Detox about, how many times a stock at $60 can get cut in half, 60 to 30, 30 to 15, 15 to 7, 7 to 3, 3 to 1, 1 to 50 cents. I mean, a stock can get cut in half a lot. I thought there were only 2 halves to make a whole, but that's a lesson to learn in investing too, right? Trying to hold on to a stock that's down, hoping it'll come back. All right, let's keep rolling. This will be our last one in part 2. We're getting long in the tooth here, but it's all good stuff. And so the more you own, the better diversified you are, rather than just increasing holdings. True diversification reduces concentration risk without increased overlap. So this is an interesting and getting a little more into the weeds on the topic. And I think what we're getting at here is that you can end up getting over diversified, where you have literally overlap all over in your portfolio. So if you look at sector ETF portfolio holdings and the broad index holdings, you start to see that 9.9% allocation to each of the 11 S&P 500 Spider Select ETFs. You have 531 holdings. 15% are in the top 10. Where in the other portfolio, you have 29 holdings and 27% are in the top 10. We are in a paradigm right now where the concentration towards the top 10 or 20 stocks in the S&P 500 is greater than it's ever been. I think we're at 35-ish% right now. So you think I have the S&P 500, that index, I'm totally diversified, but yet most of your portfolio is bunched up into those biggest positions. And that's because it's a cap weighted index, meaning the largest stock gets the largest percentage. The second largest stock gets the second largest percentage. And when the stocks get really big, that ends up with a coagulation of assets in the top stocks. It's not great.
Good word.
There you go. I used it correctly. Did I use it? I used it the other day, really in the wrong way, and it was weird. All right. The more you own, the better diversified you are. It's continued. So we're looking at drawdowns of that portfolio, broad index portfolio with more holdings. You get a bigger drawdown. So interesting. But last one, not least, we're going to have a couple more parts to this series for you. Successful investors take big risks. So akin to avoiding putting all your eggs in one basket up front, contributing over time often provides for smoother and more rewarding investment journey. 25-year investment in a 60-40 portfolio, $1,000 made in July of 2000, $250 a month with a 3% annual increase. This would be a great study for a 401k, right? How to put some money in your 401k and continue to increase it when you get a pay raise. Take half of that money and put it to your 401k contribution and take the other half to spend and bump your lifestyle.
So $111,000 turns into $324,000.
Right.
What's the next slide? Is there another one that talks about?
You just don't have to take big risks. So here you go. Yeah.
Boeing, GE, and Citigroup.
Couple examples, right?
What about NVIDIA? Can we put NVIDIA on there? Or Tesla?
That would be a good one, right? Yeah. How about these stocks, though, that were absolute bellwethers, off 77% off of its high, 51% off of its high. I mean, these are tough, right? You don't have to take big risks to get wealthy in the stock market. You have to be diversified and be smart.
That's right. And I think a lot of people, this is a good one maybe to bring up some of those examples of like Warren Buffett. I want to invest like Warren Buffett. The guy is, he's just the best investor ever. Does Warren invest, how does he, I wonder how he would respond to this slide. Does he take big risks with his,
Well, he doesn't at all. He actually invests in deep value. So when he sees something that's out of favor and he goes in and gets specially negotiated terms, and even Warren Buffett said, most all investors should be investing in diversified low-cost ETFs in traditional markets as opposed to trying to buy individual stocks. So that's from his mouth and a direct quote in some frame of those words. That's part Thanks, 2, Warren. Debunking investment myths. We're going to be back with part 3 and even part 4. Stay tuned. It's Financial Detox. Give us a subscribe and a like, and please feel free to reach out to us if you have any questions and you want individual help on your portfolio and debunking investment myths, helping you get financially detoxified. And we'll talk to you on part 3.